morning. Thank you everyone for joining. I'm very excited. We have a very special guest. So we have Kayley here today. So she's an executive director and lead strategist for the Wells Fargo Diverse Customer Segment team focused on small business. So she is responsible for leading new product development, assessing policy and procedures, enhancements, developing and managing external partnerships that increase financial inclusion for small businesses, and their owners are either unbanked or underbanked. So she's been part of Wells Fargo for over 20 years and started her career serving customers in various branch roles, ranging from bank teller to branch manager. So hi, Kayley, and thank you so much for being here.
I'm so happy to be here with the group. I spent almost half of my career in our small business line of business working directly with business owners, especially the business owners in the under 25 million revenue space. So I'm always excited to talk about managing cash flow, access to capital, and I have a lot of great materials to share with y'all today, but I also feel like it's best to be interactive. So please don't hesitate to come off mute and ask questions, throw questions in the chat. I really want just to maximize what would be most beneficial for you so we can spend as much or as little time on topics as we go through the. Well, today we will cover some details on the operating cycle, managing credit. As many of you know, cash flow is a key indicator of the financial health of the business, and positive and consistent cash flow help pay expenses, invest in new opportunities, and grow the business. So we'll spend a lot of time talking about how cash flow is an essential part of running the business. And we'll cover how it works, how it's impacted by your operating cycle, and explore different considerations during each stage. I'll share some suggestions from the bank financing part of things on how you can take control of cash flow and create a manageable plan. So let's look at the business operating cycle. There are different types of business operating cycles, largely depending a great deal on what type of business and what industry you're in. So some common characteristics are related to inventory, your fixed asset needs, fixed costs, your accounts receivable, how quickly you're getting paid, and then if your business experiences seasonality. So all the characteristics are connected to the operating cycle, but different types of businesses will have operating cycles with varying lengths. So when you're calculating your company's operating cycle, you're really looking at the period of time between when you're spending cash and the receipt of payments. So this will help you understand times when you're feeling a bit cash strapped during a period of growth. And the real magic comes when you can work to modify this number by pursuing maybe more favorable terms as a buyer or negotiating terms with your vendors as a seller and business partners. The first step of the operating cycle is to purchase things like materials that you need to make your product, or you need to acquire staff to provide the service that you offer. In this step, cash is required to pay your suppliers or staff. In the second step, you're going to conduct your operations. So you might produce your goods, store inventory to sell, or conduct the services that you offer. Then we move into the third step of the operating cycle, where you're going to sell your goods or deliver your services. Your cash flow continues to be impacted by your inventory and storage costs, as well as the costs of delivering your materials. And then lastly, you're collecting your payments for all the goods or services. So an example I like to use is if your business is a restaurant, you're collecting your receipts right when they're being made. Someone's paying for their food and taking it to eat. If you are a lawyer, you're gaining a client, presenting their case, and you're not going to be paid until the resolution of the case, which could take months. So we're creating a cash flow forecast. Different types of businesses look different, but we'll dive deeper into what the cash flow forecast looks like. It's important to identify your key assumptions about how that cash flow in and out of the business each month. So a couple of assumptions are your receivables. How quickly can you receive payment from your customers? and your payables. When are these due? For example, if your vendor requires you payment within 2 weeks of delivery, a key assumption you could make is that my payables are due within 14 days of purchase. Let's take a look closer at the cash flow management strategies. So you can forecast your cash flow over the course of the next 3 months. Your cash flow forecasts can help you plan ahead and avoid trouble before it hits. And your projections don't have to be perfect, but educated predictions can help you make smart financial decisions because you have an idea of what's on the horizon. It's important to review and update your forecast regularly, sometimes every 2 weeks, to return to your projections, update them, track changes, add new details. Monitor your burn rate carefully. Your burn rate is your negative cash flow, or the amount that you're spending each month. So if your burn rate is high, you may run out of cash, but you can avoid doing this by checking your cash flow statements carefully and monitoring each expenses, planning out those expenses. It's helpful to create cash flow statements every month. There's even software that can help do this for you. But the relationship between your cash on hand and your burn rate is really the center of how your cash flow management and these elements come together in the cash flow statements. It's recommended to plan ahead for cash shortages or unexpected expenses because there's variability month to month or even week to week. And this is especially relevant for seasonal businesses whose revenues may fluctuate throughout the year. So preparing for shortages by creating an emergency cash fund or considering having cash reserves or a line of credit available. It's helpful to incorporate technology. There's tech tools, including QuickBooks, that can help you track cash flow. And these services can really organize your income and expenses, help you schedule payments, and even invoice clients on your behalf. And lastly, it's just really critical to create and regularly review foundational documents like cash flow forecasts and cash flow statements to really have a strong foundational understanding of where the business's cash position is. Now we'll move in to chatting about managing credit. So if you forecast your cash flow for the next 3 months, you can plan ahead. But if you decide to leverage credit for shortfalls, this can be something that's helpful to understand. I'd say that first thing is really understanding what a credit profile is, because it's not just a number on a credit report, and it's not just your personal credit score, although that's a big factor, but it includes information about your business practices, your banking relationships, your past and current financial activity, and even the way you storytell through your financial statements. So in summary, really the credit profile is a big piece of what the lender sees in how you and your business operate. So a few steps to build your credit profile are to start by creating really sound financial footing. And even if you don't have immediate plans to apply for a loan, it's great to start taking steps to build credit worthiness in the name of the business. Separate personal and business expenses is I think very important by establishing a dedicated business checking account, not commingling those funds. You can also get a free copy of your personal credit report every year or through a lot of your banking relationships that can see where you are individually and clear up or address any issues. We recommend banking really strategically. Consolidating banking relationships often gives a lender a view of what's coming in and out, how the business is operating in addition to those financial statements. If you have a lot of different accounts with many financial institutions, you may just want to consider consolidating them into one. It's important to always keep your banking relationship accounts in good standing and just try to demonstrate a consistent flow of funds that shows that record of long-term stability. And then a big thing here, especially today when we're all over Zoom and there's so many convenient features, but it's still important to cultivate the human side of banking relationships, whether that's someone who you know face to face, or many institutions have folks who are virtually available to assist, but having regular visits or check-ins with your banker to have that banker get to know your business, your industry, your goals can allow the banker to become an advocate for you, because you have that relationship. So when you are ready to apply for a loan, they understand you, they understand your business, they can help pull the pieces together. I'll go off kind of script here for a moment, but in my experience, I think a lot of business owners feel a bit of vulnerability where they think they need to have all of their ducks in a row before they come to a bank. And that relationship with your banker, let them help kind of guide you and shepherd you through what dealing with their institution is like, what they're looking for. You can show them, here's my business plan, here's what I've been working on. Do you have any suggestions for how I can better articulate? They're there to be on your team and help you get to the positive outcome that you're hoping for with the underwriter. Okay, so the 5 C's of credit. Each of the 5 C's is important that you assess your business. So there's many considerations, but typically many traditional lenders use some version of this 5 C's. Your credit history shows how you've handled obligations in the past. That's both on the personal side as a guarantor and on the business side. It's a key indicator of what a lender can expect in the future. As a business owner, your personal and business credit histories are both relevant, as is information about even your personal outstanding debts. Next is collateral, often referred to as sort of the security, what's backing up that lending facility, what's the source of repayment for secured financing. So for example, investments, real estate, equipment, those are all types of collateral. Capital means business assets that can easily be turned into cash. So typically, the more of your own money that you have invested in the business, the more comfortable a lender can be that you're committed to its success, that skin in the game mentality. Conditions are all of the internal and external factors that may affect your ability to repay the loan. Internal conditions can include your plans for the loan, other resources for carrying out those plans, your experience. External conditions include everything that's beyond your control. So micro and macro economic trends, your customers, competition, regulations in your industry. Now, the last of the 5 C's is capacity. That's your ability to repay your financing. So lenders want to see that your business will generate enough cash to repay the loan and that your profitability and cash flow really determine that capacity. So we've gone through a couple of slides here. I just want to be thoughtful about pausing to see if this has sparked any questions.
Actually, Kayley, one question from me is, what is the difference between business credit and personal credit?
Yeah, it's a good question. So personal credit is something that you as an individual have taken on. So often your personal car, personal credit card, your home mortgage. Business credit is something that is in the name of the business, and likely for businesses that are, under, let's say, 50 million in annual sales. The owner or majority owners are guarantors on that credit. So many people have a tendency, I'll use my parents who are both small business owners as an example. They'll use personal credit cards because why do I need one more credit card? But you start to commingle and say, what was this purchase for personal? What was this for business? And by simply using a credit card that is in your business name, you start to establish that business credit. So that down the road, if you're looking for more facilities with higher, limits like lines of credit or loans, or you're looking to purchase real estate, you already have that established profile. Does that help answer your question?
Yep, very helpful. Thank you.
I see we have a question here. What is considered business assets? So business assets are your product, your inventory. It can be any real estate or equipment that you own. In some cases, it can be your intellectual property, anything unique about the business, but it's typically on your financial statements as an asset. compared to, the liability portion. If you wanted to share with me your industry, I'd be happy to tell. Oh, it says here, hair care. So you have a service. Often your assets are going to be your cash on hand. If you owned the building, that would be an asset if you had any equipment that was hair care. But service businesses typically don't have that equipment or inventory component. So, there may be some other sort of unsecured lending, or they're really looking at kind of a blanket filing against the business. We call that a UCC, where we say, okay, the business in itself is the asset. Does that help answer your question, Aurora? Let's take a look at each stage of the business life cycle and the considerations that you might have when it comes to your cash flow. The seed stage is the earliest stage of your business and is mainly focused on planning. This is really an ideal time to build out your business plan, develop a funding strategy. During the startup stage, your venture gets off the ground. You secure funding if you need it. That's a critical priority. If you have investors, they're typically looking for that skin in the game. So a substantial amount of personal investment, kind of your own money to get that seed started, really sends a message that you're committed to making the business successful. So as your business grows, your cash flow changes. You move into perhaps a growth cycle. You may want to take advantage of opportunities as they arrive, while at the same time you're beginning to enjoy greater access to financing. During the growth stage, you're likely prioritizing saving cash, perhaps 3 to 6 months that you expect on hand, just in case of emergencies or slow sale periods. If you plan to hire employees, you may want to consider having higher level on hand for payroll expenses before you recognize the additional revenue that employees can bring in. Next, we move to maturity. So even when your business reaches maturity, you're never really standing still. Your focus at this stage may be, staying ahead of the competition, creating efficiency improvements, monitoring that burn rate. If too much cash is flowing out, you'll evaluate whether you still need all of the services, equipment, facilities that you're using. You might start to negotiate with long-term vendors and suppliers about getting better payment terms. Hey, if I bill you faster, can I receive a discount? And there could be growth opportunities, which leads us to expansion. A major expansion can take businesses to new places. If you have substantial cash available, you may be able to use some of that to fund expansion, or you can plan to borrow money. Know that lenders will expect to see, as a result of your expansion, what do you expect in terms of your cash flow projections? How will your revenue increase? That will enable you to repay the loan. And also, as you increase your operating costs, you'll just want to pay attention to margins. How much profitability am I having as I continue to grow and scale? Next, we talk about transition. So when your business hits the transition stage, you may begin to think about your end game. Whether you plan to sell the business, you plan to keep it in the family, you want to enhance its value and stability. At this stage, there's a few things that you might want to consider. Examining cash flow from the past 3 to 5 years and preparing earning projections for potential buyers, eliminating any expenses that aren't needed, and factoring in tax implications of your exit if you plan to sell the business. Now we'll dive into what sort of financing options are available. There's many types, and knowing the different terms will help you understand your options. So we have two main categories of credit. You have secured, so that's backed by the collateral or your assets, cash, equipment, real estate, a lien on the business. And then you have unsecured, so it requires no collateral, but it's entirely dependent on your credit and strong cash flow. I will say that both are very dependent on good, strong credit and strong repayability, but unsecured financing is generally for smaller amounts. A credit card is a good example of an unsecured credit facility. The different types of credit break down based on their terms and other details. So let's look at a few of the basics. So your credit card is much like a personal credit card. It's a great way, like I mentioned, to begin establishing that business credit. You can pay your monthly expenses, also can perhaps get some special billing options. Many cases, if you do have employees, there's an ability for them to spend through the business credit. You'll have different reporting tools and ideally take advantage of some rewards programs. Next, a business line of credit is an open revolving account, similar to a credit card, but you're probably not going to pay it back every month. It lets you borrow available funds when you need them up to a given amount, and then you can pay what you're owed at any time. Typically, lenders like to see a line of credit revolve at least annually. If you're looking to finance something that's going to be longer than a year, probably a term loan is more a better appetite. Commercial real estate financing allows you to do a couple things. You can fund and expand your business by purchasing new property, doing property improvements. You can free up cash by refinancing at a lower interest rate, although probably not in this interest rate environment. You can take on extended terms or even borrow against the equity. I think a key piece about commercial real estate is that it's when you think of long term, it's a tool that becomes an income for you, whether you end up selling the property or renting the property. If you no longer operate the business, it's still ideally generating a positive cash flow. The Small Business Administration offers loans and lines of credit through banks. Wells Fargo, as an example, is a preferred lender, so we're able to help navigate some of the red tape that you might have around small business administration as a preferred lender. But it's designed to support some of our smallest businesses. The loans are where SBA guarantees a portion of that for the financial institution, but the credit requirements are similar for other loans and lines. The key here is that if you're looking to purchase real estate, there's often a much lower down payment with an SBA guarantee and longer repayment terms. And finally, many banks offer specialized financing for healthcare practices, typically your doctors, dentists, optometrists, veterinarians, that we can help finance new practice ownership, growing a practice with fixed rate loans, and just a variety of repayment options. I tend to get questions here, so I'll just stop to see if there are any questions that have come up.
Kayley, there's a few comments about what types of credit people have used. So SBA loans, lines of credit, cash flow. Can you talk a little bit more about cash flow loans? Maybe that's something that has not come up yet.
Sorry, did you say cash flow loans?
Yes.
I'd love to hear more about kind of what an example of a cash flow loan is. So what's the kind of the borrowing cause that you'd be looking for? Is it just a fixed amount to inject into the business? I'm not seeing the comments, but is there any context?
Not too much context, but maybe around receivables. So let's say you're an e-commerce company and you are able to, I guess, peg your sales, or you're a subscription company and you peg your subscriptions against a loan. Is that possible? Factoring. There we go.
Yes, yes. What a great tee up. So we'll talk about a few different financing vehicles. These are typically your non-traditional financing, although Wells Fargo does factoring, but at the dollar amount of multi-million-dollar companies. But there are a lot of fintechs that do factoring where they can take a look at your receivables and sort of advance you money ahead of time. I would caution with any financing, both traditional and non-traditional, just be very cognizant of, at the end of the day, what is this interest rate? And with factoring, are they advancing, or are they actually buying your receivable? And perhaps if they're paying you only 80% of what that receivable is going to be at the end of the day, certainly they're taking on some risk, but it can be a slippery slope if you start to become dependent on it and you're losing a significant portion of revenue. But it's definitely a vehicle that's non-traditional, and certainly in some of the small spaces can help if you haven't been qualified for credit in the past. So let me just talk a bit about some of these other vehicles, and then we can spend some time to see if that brought up any other questions. So if you're looking outside the box to secure financing, there are so many local and national organizations. There's resources often at the city level through business planning, through mayor's offices, chambers of commerce, all connections that can either lend to you directly, help you look into grants, help you look into micro lenders, seller financing of big ticket items. So let's say someone wants to sell their piece of real estate, they can finance it directly. So you can get money from the business account earlier by saying, I just want to work with you directly rather than a bank. And sometimes people have a benefit to do that because they're still benefiting from appreciation of the asset and taxes. They may offer you 0% for a year or a lower sticker price to be able to do a seller carry. Factoring is commonly, that cash flow or accounts receivable financing. So you get the money by collecting the receivables earlier or selling the invoice to a finance company in exchange for a percent. This is often if you need something kind of immediate. Peer-to-peer lending is where online companies create a forum of interconnecting small business owners with investors who are looking to offer credit. You can request a loan with multiple individuals, or institutional lenders can decide whether or not to provide funding. This can often be sort of like incubator financing, where once you pay off the loan, the investors get their principal investment back along with interest. CDFIs, or for those not familiar with the acronym, community development deposit institutions, often do their own financing. Wells Fargo, for example, provides funds to CDFIs because if we, by our regulations, are unable to lend to certain people, we still want to be seen as part of that ecosystem, helping CDFIs lend sort of indirectly. They may not have as rigid requirements, and Wells Fargo has the ability to connect you directly with a CDFI. So if you're not eligible for financing with us, we can say, hey, here's a CDFI in your community that we work with. Get with them and see what lending options they have. And they may also be able to direct you to local or federal programs that could be available. And then lastly, there's development grants. A lot of nonprofits that are dedicated to helping small businesses. And I've heard feedback from business owners that looking into grants is daunting because there's application and paperwork, but also keep in mind that many of these institutions, like your chambers of commerce, like your CDFIs, like your small business resources in the community, they often have subject matter expertise who can sit with you and help you navigate that process or give you guidance and best practices for securing grants. I have a question here. Is there a specific time the business should be in a seed stage? As a general rule, I'd say no, but keep in mind the seed stage is really the planning stage. That's writing your business plan, coming up with your projections. So it's sort of pre-revenue. It's before you hit the ground running and start providing your services or goods. All right, so now we'll take a look at what lenders may look for. We've talked about this a little throughout, but financing can seem like a numbers game and all focused on credit information and financial statements, and these are essential, but keep in mind there's real people at the end of these decisions. So the more you understand the lender's point of view, perhaps the more effective your storytelling can be. If you show a potential lender that your company has steady cash flow, an effective business plan, you're more likely to obtain credit. When you approach your banker, be prepared to discuss a few topics. What's the purpose of your credit request, being able to outline and explain exactly how you'll use the money, why the amount you're looking for is realistic, being really transparent about what you need the cash for helps your banker present you with the options that meet your needs. An example that I'll use here is perhaps I worked with a business owner who was looking for $150,000 line of credit. And what they were intending to use that for was to purchase 2 vehicles. Well, I, as a banker, wouldn't be setting that business owner up for success without exploring, hey, could it be better for the business if you financed these on a term loan over a longer period of time so you don't tie up line of credit funds, which are really meant to be more short term. Another component is your credit history, making sure that there are no surprises on your credit profile, the business credit profile, particularly with your payment history, and that includes your vendors. The company finances, demonstrating that ability to repay the loan on time is often what we see in your financial details. Providing cash flow projections for at least 12 months is recommended, so that you're on top of the finances and you can account for any variations. And then don't skimp on the details. It's important to have a really correct and complete application, get dates and details right, ensure your sales and income numbers match, what's on last year's tax return and what your interim financial statements assess. Enhancing your cash flow. Because the cash flow is such a critical piece of financing, here's a couple of tips to help you improve it. Think about how you can accelerate your inflows, sending invoices immediately, following up, perhaps offering multiple payment options to bring in that revenue. We often hear things like card is king these days. People want to be able to pay through card. You can also, depending on your industry, potentially offer discounts to receive payment. Hey, if you pay me in 2 weeks instead of 4, I'll give you 10% off. Monitoring your costs, so tracking those bills, due dates, understanding how often your inventory is turning, knowing your payroll obligations. Those are all calculations that you can do. Watching your expenses, so using a business credit card or rewards program, having volume discounts. Do I get a discount if I buy more? I know that I'll end up needing this. Are there barter arrangements that you can engage in to conserve or control your expenses? Being thoughtful about taxes, just setting aside the appropriate percentage each month to avoid any penalties. And then lastly, challenge everything. Are you getting the maximum value in every vendor relationships? Are all of your expenses, is there anything you can cut without affecting your efficiency or profitability? I'll just touch on a few educational resources here. On wellsfargo.com, under business resources, we have a lot of articles that talk about managing cash flow, advice for receiving processing payments. There's industry specifics. There's landing pages that are focused on women business owners and some of the coaching circles that we have. There's even content on our diverse business owners. So I'd encourage you to check this out. Some other great resources that I love are on the SBA website. I always, assess your local Chamber of Commerce relationship, something that you might consider if you are a woman or a racially, ethnically diverse business owner is, does it make sense for me to pay to be certified as a diverse supplier? We know a lot of companies have goals around working with diverse suppliers. So, could that help you secure business by being certified? And then of course, our great partners here at MasterCard have great communities of small business owners that you can network, learn about growth strategies, promoting your business. And of course, there's additional discussion and Q&A through the digital doors at MasterCard. We have a few minutes now for just kind of some open Q&A, whether it's related to cash flow, credit, lenders. I'd really love just to hear sort of what's on your mind, and I can give you my perspective.
Kaylee, thank you so much for walking us through that. That was super helpful. We did have a question in the chat. Their question was, is it possible to move personal credit over to your business credit, particularly around credit cards?
That's a great question, and one that is very challenging. It's one of the reasons why I'm such an advocate for talking about people really early starting with business credit cards as something separate, because it becomes very, very difficult to unwind what is personal and what was business. And often lenders aren't particularly looking to refinance debt like credit card debt. Is it possible? It can be, probably for more of your untraditional lenders, some of the outside of the box that we mentioned, but I strongly suggest keeping those separate, establishing a credit profile for the business, because then you will never have to outline and go through some of the arduous process of unwinding that. It's also just, you can invest in the business, right? That's a great example of skin in the game, using your personal funds, but the separation is key. I can't tell you how many business owners I've worked with over the years who were so proud to have, seeded their company $50,000, but they did it all through personal credit products like credit cards, like home equities, and it's very, very challenging to refinance that debt and to even structure new debt, because it's very difficult to show that it was exclusively for business purposes.
Thank you, Kaylee. I think we do have one in the Q&A as well.
Yeah, I see this too. So recommendations not to seek a loan because your business is so small and little to no debt. So here's the thing, little to no debt can also be a pride point. Like I said, I've done this myself. I've invested in myself, but it can also be like driving a car until you run out of gas, right? Like if you have something that's established for emergencies, when you need it, I would recommend it. With a small business, a credit card for everyday expenses is not taking on debt, right? In fact, you're stretching some of your payables because you're giving yourself a month to repay that credit card, rather than perhaps paying things piecemeal, as they come in. So I would consider debt to not be a loan, right? I wouldn't take on $50,000 that you need to start repaying on if you don't need it, but there's certainly credit facilities available that could allow business credit to be established without you actually borrowing funds because you were paying them at the end of the statement cycle.
Thank you, Kaylee. And to follow up on that, what advice would you have for someone just starting out? Actually, she just had a follow up on that as well. So her credit card has very high monthly interest. So what would you recommend?
So if you pay your credit card off every statement cycle, you will not accrue interest. So that's my suggestion. If you have to, roll something over because cash flow is tight, then you're ending up with paying an interest on it. But if you can leverage that credit card for your day-to-day expenses, just like you would the cash in your bank account, and pay it off before it accrues interest, then you are benefiting from kind of three things, right? You're keeping cash on hand, you're hopefully earning rewards, and you're establishing business credit. I'm obviously going to be partial to Wells Fargo's business card that we have relaunching here this year. But there's great resources out there that help compare what are you getting for what you're paying. What's the annual fee? How lucrative is the rewards program? The interest rate, you should really only have to consider if you plan to not pay that balance off every month, which is also fine, right? There may be times of seasonality, times of cash shortfall where you leverage having that credit facility available. But if you don't want to pay interest on a credit card, you don't have to. You just pay that balance back in full.
Thanks, Kaylee. And we have one more from Tay, and thanks, Aurora, for the question. Tay is asking, what are some local types of programs we should look out for?
Another great question. So my main responsibilities in my current role are that I work with a lot of our national diverse chamber of commerce and professional organizations. So the U.S. Black Chamber, the U.S. Hispanic Chamber, the National Association of Women Business Owners. There's U.S. PAC and National ACE, which are both Asian Pacific Islander organizations that have a ton of great programming that is in a couple of buckets. So technical assistance is programming like this that helps give you educations, resources, a networking circle, but it also exposes you to a broader network of an ecosystem that's part of that. And that includes community lenders, that includes incubators who are primarily focused on startup. It includes thought leadership who can help navigate you to. I was in a meeting with a group of mayors and business owners a couple of months ago, and this woman owned a dry cleaning company, and she found out about this grant, and she said, I printed it out and I just started going to businesses saying, have you heard about this? It's $2,500, but the city wants to invest in our businesses. You should look into this. And so I think, if anything, it's probably overwhelming the amount of resources and companies out there that are both nonprofit and financial institutions. But I would start with your chambers of commerce and professional networks. I would look into some of the business development that your local legislators are working on. They often have grant programs or resources that can help direct you to different opportunities. And don't feel like you have to start at one place depending on your stage. Ideally, you work with a financial institution that will give you advice and say, here's what we can help you with. And then here's when we need to bring in partners because we are either regulated or don't have an appetite for X, Y, and Z, but here's who does. So when I mention that we refer directly to CDFIs, our goal there is to help a business owner feel like they have a trusted partner, that they're not, there's a lot of predatory lending out there online that will give you access to cash at a high cost. So my advice would just be to explore, do your research when it comes to repayment terms, talk to those who you trust, talk to your banker. But there's a lot out there in the ecosystem really focused on the propping up our small businesses, keeping our small business doors open.
Thank you, Kaylee. And there was a few people on the chat talking about the SBA. I'm curious what the process looks like for an SBA loan and what could those loans be used for? And how does the SBA vary as compared to going to a bank directly?
So typically to work with the SBA for lending, you're going to work with a financial institution. The SBA is the vehicle and helps helps guarantee some of that lending so that it's less risky for banks. The SBA is basically saying, if I cover 50, I will cover 50% of this. So, be more aggressive lender because I want you to invest in this small business. And if something goes south, you have the government as a guarantor. I'd say the most common types of lending with SBA are going to be for fixed assets. You're purchasing equipment, you're purchasing real estate, perhaps you're purchasing another business. They typically need 2 years in business and showing profitability. They won't fund I think they refer to it as kind of a turnaround where, hey, I'm going to buy this business that hasn't been successful, but I'm going to make it successful. They want to see that consistent, proven track record of positive cash flow. But they also guarantee some lines of credit. So if you're looking for something that is sort of in that emergency fund, that's available. I can speak to Wells Fargo as a preferred lender. We do all of the underwriting in-house. So that means that the SBA has given us their stamp of approval that we don't have to go back and forth and back and forth with them. We have the documents that we collect, we underwrite, and then they provide the guarantee so that it's easier on a business owner and we can help like shepherd you through that process. But they have a ton of great resources that will talk about what their loan programs are, what they're designed to do, what their criteria is, and then the lender that you choose to work with kind of delivers the credit facility to you.
Great, that was very helpful, Kaylee. Thank you. Whitney actually mentioned that she was able to get an SBA loan to purchase a commercial building there.
That's great. And you can, there's other vehicles for financing commercial real estate, but SBA is wonderful because you don't have to put as much cash down and you can have a fully amortizing loan like most of our mortgages. Some of your other real estate options may say, okay, we'll give you this loan and then your term is up in 5 years and we need to relook at your financials. You know, we're in a different interest rate environment. So I'm a huge fan of SBA for small businesses because it really allows you to stretch your dollar.
And Kaylee, I don't think there's any more questions, but if there's any piece of advice in terms of financing you would have for small businesses here, what would you say it is?
I would just stay on top of knowing your financial story. It's easy as a business owner to be so focused on what you do and what you do well that that task can be such a burden. But the better you know your books and the better you know kind of what's on the horizon that you can advocate for yourself, the more your banker is going to be able to advocate for you on their end. So I would be transparent, I would be curious, and I would stay organized.
Awesome. And with that, I think we're going to close it out. Thank you again for Kaylee for walking us through everything. I definitely learned a ton. I had no idea the SBA was not a direct financing option, so that was helpful to figure out. So, Kaylee, thank you again so much for joining and answering all of our questions.
Thanks for having me.
Bye, everyone.